Hey, oh, there it is. Man, I ran into technical glitches. Can you? Jeez. Anyways, welcome to Forex.Today. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. ECB decision out, CPI coming up in 45 minutes. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hey, my name is Wayne McDonald. I'm a currency trader. I love trading Forex. I was up in the middle of the night trading Forex. Of course, one of those nights. Anyways, lots of interesting things. Man. Anyways, welcome. Let's talk technicals. Let's talk fundamentals. We have monetary policy at the ECB. We got CPI coming out, which is actually a precursor, something towards the Fed meeting next week on Wednesday. So there's lots of interesting things to talk about. I don't know. I'm tired and I'm cranky and I'm bitchy. So maybe we won't talk so much. Maybe we'll just listen to the press conference after the CPI news and just one of those days. So ask questions, get involved. I will do my best to help. If you want to learn more about technical and fundamental analysis, monetary policy, central banking, and all that kind of stuff, there are many resources available to you, and all the links are in the description below. Link to my book, link to free training courses, link to paid training courses, a link to my chart templates, and a link to Trader's Way, which is a trustworthy broker with fast execution speeds, narrow spreads, huge swaps. Why don't you visit tradersway.com, open up a demo account, give them an opportunity to earn your loyalty and respect. Thank you, Peter, for posting those comments in the chat. Okay. Awesome. Okay. So what we're looking at is a policy that is somewhat stimulative, or we should say accommodative, to the European economy. People are worried because, of inflation levels of 5.5. They're going to have to raise interest rates and be forced to do stuff like that in a slowing economy, and that's not good, and they haven't done that, so they've left interest rates negative. They're rolling off their QE, so interesting. All right, cool. So that's all right, and the world seems to be okay with that. Yesterday, we had euro weakness for about 50 pips, and now we have a euro strength for about 100 pips. Net change, 50. So interesting. Mark your lines. Identify things like support and resistance. Okay, so you should be looking at stuff like this across the board. Let's get off the fiber. Okay, up to resistance and then back around, huh? Interesting. Take a look at Euro Swissy. This is one I've been talking about for a while, because we were messing around with parity, and I said, I wonder if the Swiss National Bank's going to get involved at parity. That's parity. Yeah, boy. So it'll be interesting to see what we're doing now up at this level. I'm going to mark this one. Okay, and then I've already marked this one, but let me bring it across. Okay, obviously interesting levels of price. Zipping around here, Euro CAD. Okay. Mark these up. Come on, MT4. Okay. Just mark them up. Trap them. Don't get too excited. Make sure you're just doing your job. This one moved really well. Okay, again, mark your lines. Some of these are higher highs. Some of them are not higher highs. Euro Noki getting crushed. Okay, that's probably enough. Euro Aussie, actually, let's take a look at this. Okay. I suffered from a poor entry yesterday, sat there for about 5 hours, and then because of the piss poor entry, had to leave it early. And then, of course, it performed. And the interesting thing is, that is exactly my target. Like, oh, Jesus. So I left some money on the table there. It just drives me freaking nuts. All right, let's take a look. Go around the world here. Pig dog coming off a bottom here. Oh, drawing tool not working. See, something went weird. I had to reset a lot of things. I tried to do a live stream early to cover the ECB, and all of a sudden, nothing on the computer would work. So hang on. I got to kill this, and I got to do it from the task manager. And task. Now I gotta. Good. Okay. So there's our little bottom here. There's a potential high. There's a potential high. Okay. Okay. Meanwhile, it's doing nothing fast. One of the things I thought I'd do today is, put a spotlight on the hourly 21. But like I said, I think today I just want to listen to the news. Okay. There's that euro dollar just climbing up. We got to keep an eye on that. We're right at resistance, so don't get too excited. Although there's a potential roll reversal there. Aussie dollar, taking a look at Aussie dollar. Okay, risk on. Okay, remember, we were here. It came up, out, came down, stabilized on the roll reversal, and bulls have opportunities here. As you can see, this, and this are daily buy zones. Okay, like down here, double bottom, buy, 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 and then it collapsed through. Started again, buy, 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 collapsed through. Started again, buy, buy. So, okay. Depends on where you are in the month, and that's the interesting thing. It's early in the month. If it was late in the month, you'd already be playing next month's pivots, but it's maybe too early for that. So anyways, where will a bear step in? A bear might step in on this number. It's about a 50%. Okay, and then, of course, this number. Okay, that's about a 786, probably even more than that, so maybe not. You might want to look right and say, okay, this is monthly resistance, but this is next week's sell zone. So if I was a bear, and then you see it ends up being the same thing. If you were a bear, you'd be trying to rotate around like this. Okay, so at the top you'd look for, kind of like that type of price action on a smaller time frame. Hoorah. Okay, cool. Zip around with commodities. WTI stabling at around 108. Gold, let's zoom more into gold here. Okay, gold has formed a bottom here. Great, but has not breached our resistance area. Okay, and is now, if you follow the price line here, we're starting to tickle some first level resistance. Okay. But we are sort of still farting around the 2,000 mark. like I want to show you here. I guess I can give you a little more commentary. Okay, stabilized right there, new higher high. So you have to decide what do you want to do today. If you're a bullsy bull, you're looking at that. Okay, and that would be the proper time of day. In fact, maybe we want to watch that. And silver, no. Bitcoin came down hard today. Okay, so remember doing this yesterday. We went through and I marked all the prices I thought would be important on Bitcoin. And what did we do? Okay, we rolled over and dropped like a ton of bricks. The pattern is the one I just drew on the other pair. Okay, it went up, okay, and then formed a top and then rolled over. We call that at FX Bootcamp, we call that an old man. Okay, and you'd have to read my book, I suppose. Funny to see a pattern like this. You're like, wait, you call that what? There's a funny name for that? Uh-huh. Yeah. Yeah. Uh-huh. Yep. As they say in Canada, for sure. Oh, for sure, eh? Yeah. I think that's it. So actually, I think it might be fun to play out the... Wait, this is the wrong one. Is this the right one? Guess so. Instead of watching Euro, we can watch this as a direction. Okay, remember this time of day trading oil, the most important thing that you do is decide whether you're a bull or a bear. The rest is just a simple entry. And when you're trading this time of day, especially if you're, it's sort of an intraday scalp, you just pick your direction, take your shot, and then manage the risk. You're either out quickly or you hold it a couple hours. Okay, and so you can see going into this, you had it trapped here, bear sell high, and down here, bulls buy low. You might want to pay attention to psych levels and stuff. Okay, like we got 110 at the bottom, 110. Okay, we have a real body here at 111. Then you're probably going to look at 112, which is just about here. Okay, so you could mark that as an area of interest if you were a bull. So you'd go 112. Okay, so as it falls, bulls are getting interested. Bears would have already sold it at basically, they're keeping it below 115. Okay. Remember, a chart like this won't tell you direction. You have to walk into this chart already knowing what you intend to do. Yeah, I'll throw down Lagarde in a bit. That's not till 8:30, but I want to stay with this until we get CPI. Oh my God, my taxes are ready. Ho 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 ho. Whoa. Nice. Got to go in. Pay the money to pay the money. Dude, that's pretty good timing. What's the date? The 10th? Oh, it's not bad. Don't forget to file your business taxes, y'all. All right. Anyways, kicking off. What are we kicking off? 1250. Interesting. All right. You are always so far away. Ah, da, 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 da. Da, 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 da. Da, 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 da. 16 minutes until the press conference, but bear in mind, we also have that whole wonderful CPI, although I don't think it's actually terribly important for fundamental analysis. It's probably a source of vol. What do you think? Da, 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 like you want me to. So many things are not working on my computer right now. You're kidding me. Why does this always happen right at times like this? It's crazy. No, this is just not working. And what? What's up, Cebu? Isn't Cebu an island in the Philippines? I mean, you got to know your Filipino islands, man. I don't know much, but I know my Filipino islands. All right, so there's all kinds of things I'm trying to do in the background, and none of it's working. But I got the ECB, so we'll listen to that in the background. I was trying to get a floating player. I've tried two different techniques, and it hasn't worked. So I have one last technique. So we'll listen to that. But meanwhile, we got our CPI. Okay. Bears have sold, bulls have bought. Okay. So everybody's in. By the way, I want to see how bad the lag is today. I feel like there's a lag. Can you type in the number 1, please? Okay, well, that's not bad. Thank you. That's about 6 seconds. I can live with that. By the way, I think Arve's singing for us later today. How many CPI? 1. Okay, about 11 minutes. Turns out the war in the Ukraine is not over today, huh? Yesterday, when the stock market rallied, lots and lots of people were talking about that's the bottom, everybody's buying, and I thought maybe it's just short covering. So we'll see how the next few days play out, but I have a feeling there's still a lot of risk in the market that we need a couple more weeks. The Western world needs to kind of get bored. I know it's tragic, especially on a human level, but it happens all the time when it comes to trading and investing in the news cycle. 2 weeks from now, they're like, oh, there's going to be a 9th peace talks meeting. And people will just kind of, they're going to worry more about spring break or something, right? So we just got to kind of grind through this. And I'm really looking forward to the last week of March, but I want to make money before then, huh? More capitulation? We'll see. A lot of people, I mean, we all saw something coming, but we treated it like an unlikely risk event, and then it happened. So a lot of people have to reposition. Remember, bigger portfolios need more time to adjust, but also they use a lot less leverage, so, they can take some pain and then readjust appropriately. Okay, when you're leveraged 500 to 1, somebody sneezes and you go bankrupt, right? So everyone's concerned. Everyone's trying to play it right. Half the market's probably trying to save their butt. The other ones are trying to get rich. And so it's one of these things. In many ways, it's very often a 50-50 market. Okay, which means you better know what you want to do, and then you need to do it right. So I had a couple of piss poor entries. They weren't bad trades. They were just poor entries. And then I felt unsatisfied the way that the market performed in the hours after taking the trades. So then I thought, well, now my risk is increased, and then the reward starts to look less likely. And so anyways, I mismanaged by taking tiny losses. And then I wake up and all my limit orders, my targets were all hit. But then, of course, they flipped in reverse. So I might have, let's say, missed a target by 3 pips. I mean, how many times has that happened? Right? You hit your target, but you don't cover the spread. You wake up the next morning, and instead of making 50 or 100 pips or whatever your target was for your day trade, you wake up and you lost money because it flipped, reverse, skyrocketed, hit your stop loss, but never hit your limit order. And instead of making, whatever, you lose whatever. And so anyway, so I just kind of walked away neutral, and son of a. And that's what happens when you got a piss poor entry. You wake up super tired in the morning and you're pissed off. Huh? Anybody been there? it's funny. The trades you miss are always winners because you erase the trades you miss that are losers. You erase that from your mind, and you only miss winners. Of course, that's dangerous, right? That's dangerous thinking. Because what you do is you talk yourself into hanging with mediocre trades. I'm not supposed to have mediocre trades, but it happens, man. Happens. It's a real world. So sometimes, it carries through, but I never got the volume and volatility. I don't know if you traded Asia last night, but it started out great. And then, there's this period in time when there's, it's sort of like, I guess it's right around when China goes to lunch and they take a 90-minute break. The market closes for 90 minutes. What time is that? 10:30, I guess. And it just stopped. All the volume stopped, which makes sense. India didn't carry it through. Japan usually comes back from lunch. So when Japan comes back from lunch, China goes on lunch, right? And so Japan came back. India's online. Australia, New Zealand's online. Europe is closed. New York is closed, right? And the new volume didn't come back. So kind of China went away. The rest of Asia came back, but just nothing happened. So I adjusted, and then it moved with London, right? But it's just, I don't know. If I had a better entry, I would have stuck with it. And that's what it comes down to. You got to have good entries. Sometimes you miss them. Well, Richard says it's about buying low and selling high, but one of the issues is, you're in periods. Let me just draw right over top of my chart, so I'll make it a little fatter. Sometimes you have a period when there's a big down, and then there's a retracement. So what do? Is this a sell, or is it going higher? And sometimes you have to deal with that, right? And so sometimes it does, right? And so if you kind of are here instead of here, there's a much different risk management profile that must be had. And I was on the second wave, not the first wave. And I got a nice little psych level. But here's the thing, like let me just clear out nat gas. Let's just make this easy to see. Sometimes you're in a situation, and we were in that situation last night where there was a big down followed by a big up, and you have to decide, bulls and bears are deciding which way, right? So what do you do when you got a 15-minute 21 down, okay, and a 21 1 hour up? And so this was actually what I had set up. Okay, so obviously there's a top, okay? And I had sold here and targeted here. And it did this. But what happened is this just took hours. Like this was hours. And it started to do that, and I'm like, yeah, just give me my money. Okay. And I mean, it was tiny, like tiny, ridiculous small, like 5 pips, right? But still, son of a biatch. Okay. Tom doesn't like fractal geometry, aka time conversion. Yeah, well, it's tricky. It's not a trick, but it is tricky. All right, so we got US CPI coming up. Pound weak. Aussie off, euro. Okay. All right. So I guess what we could do is zippity-doo-dah over here. I'll leave that. I guess we got to leave it here, huh? Look at that. Back below the role reversal, huh? High volatility, event-driven strategy. Hua? So why don't we flip this over into a price action play? And you want to connect the lines. Okay. And we call that a role reversal, standard operating procedure for trading. Well, Tom, everybody knows there's high inflation. Louis or Louise says, hey, have you ever thought about using a custom indicator where your cell phone will alert you to possible entries? You have to understand, I like watching the market. That wasn't the issue. The issue is I basically had to babysit a mediocre entry in a cross market, if you will. So if I was in a better situation going in, it would have been better. Numbers should be out.
This now, sometime after the end of the bank's bond buying program rather than shortly after. So that's something. The latest reading of consumer prices, meanwhile, is about to be published in the US. So let's briefly rejoin our US colleagues for that data.
No, not out. I thought it was out. I'm seconds early, I guess, huh?
February release of CPI Consumer Price Index, of course, is going to be huge. The month following 7.5 that could get level of inflation.
So it is higher. But not terrible, right? In particular, core could be higher because of the high oil price. Well, core is stripping that out, yeah. So anyways. Dow Jones down 1%. Let's move over to the ECB. Initial jobless claims 227. 10-year T-note at 1.96. So that's good. I mean, we went from it dropped to 1.75. We're back at basically 2%, which is a very, very much a risk on play. It over here, man. They haven't shut the music off. That's not me. It's them.
Welcome to the ECB press conference. I'm joined on stage by President Lagarde and by Vice President de Guindos. My name is Wolfgang Preußel. Later in the question and answer part, I would like to ask you to
guy's the
turn
life
on
of the
your
party,
camera
huh?
so that we can hear and see you when you ask a question. I will now give the floor to President Lagarde. President Lagarde, please.
You don't want to go to Vegas with that guy. Snoozer.
Thank you very much, Wolfgang. Good afternoon to all of you.
Thank you, Madam
The Vice
Lagarde.
President and I welcome you to our press conference. The Russian invasion of Ukraine is a watershed for Europe. The Governing Council wants to express its full support to the people of Ukraine. We will ensure smooth liquidity conditions
Wow, they're
and
having
implement
problems,
the
huh?
sanctions
Teleprompter
decided
not
by
working, the
European
music guy was
Union
off.
and European governments.
Sweating bullets.
We will take whatever action is needed to fulfill the ECB's mandate to pursue price stability and to safeguard financial stability.
See what I'm doing here?
The Russia-Ukraine war will have a material impact on economic activity and inflation through higher energy and commodity prices, the disruption of international commerce, and weaker confidence. The extent of these effects will depend on how the conflict evolves, on the impact of current sanctions, and on possible further measures. In recognition of the highly uncertain environment, the Governing Council considered a range of scenarios in today's meeting. The impact of the Russia-Ukraine war has to be assessed in the context of solid underlying conditions for the euro area economy, helped by ample policy support. The recovery of the economy is boosted by the fading impact of the Omicron coronavirus variant. Supply bottlenecks have been showing some signs of easing, and the labour market has been improving further. In the baseline of the new staff projections, which incorporate
Okay,
a
we're right
first
on the
assessment
111 line.
of the implications of the war, GDP growth has been revised downwards for the near term, owing to the war in Ukraine. The projections foresee the economy growing at 3.7% in 22, 2.8% in 23, and 1.6% in 24. Inflation has continued to surprise on the upside
So
because
I'll
of
show you.
unexpectedly
We'll use this as
high
an
energy
opportunity to
costs.
scalp.
Price rises have also become more
What do you wanna
broadly
do?
based. The baseline for
25,
inflation in the new
25
staff
OCO.
projections has been revised upwards significantly, with
Let's
annual
do it
inflation
smaller just so you can see it. Let's
at
do
5.1%
20,
in
20
22,
OCO.
2.1% in 23, and 1.9% in 24.
I'll throw down a trade and I'll show you how it works. You see how I got one on the
Inflation,
bottom, one at the top?
excluding food and energy, is projected to average 2.6%
Just want
in
to show you how that
22,
works.
1.8%
There's two
in
exits on here
23,
and an entry.
and 1.9% in 24, also
It's
higher
not about right.
than
I'm
in
just
the
showing you
than the
direction.
December
Or
projections.
not direction, but risk.
Longer-term inflation expectations
Now, what you can do, of course,
across a
is if you
range
make the
of
higher high,
measures
so you can jack this
have
up a little bit and say
re-anchored
you're
at
risking
our
20 to
inflation
make
target.
40 or something, right?
The Governing Council sees it as increasingly likely that inflation will stabilize at its 2% target
And this
over
should
the
probably
medium
be
term.
below that. Let's adjust this.
In alternative scenarios for the economic and
Anyways,
financial
so now you
impact
set
of the
that up.
war,
Now you kind of set it and
which
forget
will
it.
be
Now,
published
typically, you want to be
together
at the
with the
bottom, at the
staff
top, and not in the
projections
middle.
on our
So I'm not
website,
showing you a method of scalping.
economic
I'm showing you a
activity
method
could be
of risk
dampened
management.
significantly by a steeper rise in energy and commodity prices and a more severe drag on trade and sentiment. Inflation could be considerably higher in the near term. However, in all scenarios, inflation is still expected to decrease progressively and settle at levels around our 2% inflation target in 24. Based on our updated assessment
Well, they're
and
struggling
taking
with this
into
meeting, huh?
account the uncertain environment, the Governing Council today revised the purchase schedule for its asset purchase program schedule for the coming months. Monthly net purchases under the APP will amount to 40 billion in April, 30 billion in May, and 20 billion in June. The calibration of net purchases for the third quarter will be data dependent and reflect our evolving assessment of the outlook. If the incoming data support the expectation that the medium-term inflation outlook will not weaken even after the end of our net asset purchases, the Governing Council will conclude net purchases under the APP in the third quarter.
Third quarter.
If the
Did they
medium-term
move that
inflation
out?
outlook changes,
Was it always third quarter?
and if financing conditions become inconsistent with further progress towards our 2% target, we stand ready to revise our schedule for net asset purchases in terms of size and/or duration. Any adjustments to the key ECB interest rates will take place sometime after the end of our net purchases under the APP and will be gradual. The path for the key ECB
All right,
interest
so
rates
next
will
year,
continue to be determined
maybe a rate hike, but not
by
this
the
year.
Governing Council's forward guidance and by its strategic commitment to stabilize inflation at 2% over the medium term. Accordingly, the Governing Council expects the key ECB rates to remain at their present level until it sees inflation reaching 2%, well ahead of the end of its projection horizon and
Well,
durably
Anne, it's
for
more
the
like
rest
they
of the
can't do anything
projection
about it.
horizon, and it judges that
So-
realized
So, guys, you got to
progress
think about it. Why don't, right? On says they don't give an F about inflation. Well, the thing is, there's inflation, and if they jack up interest rates, that will slow the economy while still having elevated levels of inflation, because much of the inflation in the Eurozone has nothing to do with the economy. So slowing their economy down and having high prices is just not an option for them. So they do care, but they can't do anything about it. And I've been telling you guys for probably a decade now that the ECB is impotent.
in underlying inflation is sufficiently advanced to be consistent with inflation stabilizing
Transitory
at 2%
actually now
over
made
the
it, I
medium
think,
term.
means more like they can't do anything about it anyways.
We also confirmed our other policy measures as
Right.
detailed
It used to
in
mean
the
like
press
exactly
release
what you're saying, but now
published today at 1:45.
let me pause it again. It used to mean like inflation would normalize, right, as supply and demand moves. But now what they're saying is out of supply and demand, okay, central bank policy impacts demand. When demand is low, they lower interest rates and make money cheap. That pushes up demand. When demand is too high, they raise interest rates, makes money expensive, and lowers demand. But they're like, dude, if we raise interest rates, that'll lower demand. But high interest rates are based on supply, and they can't do anything about the supply. So they're like, this is kind of transitory, right? But it's sort of, it's changed its meaning slightly. Okay? So it's more like, hey guys, this is a supply side issue. We have a supply chain issue. We have a threat to oil. Okay? All that kind of stuff. And lowering the interest rate or raising the interest rate won't change that. But if you do raise the interest rate, it'll lower demand from D1 to D2. And as you guys know, this is price, this is quantity. Okay. It's okay. Normally it would lower price, but it probably won't. It'll just destroy demand, because this supply is not an equilibrium of supply and demand. So you can almost do it like this now. You can almost do it like you would for currency, right? Like supply is like vertical. There's just that much. Demand can go up and down, but supply doesn't necessarily need to shift. You see? So anyways, let's go back to this.
I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and
so
monetary
it's not a
conditions.
demand equation. It's supply side.
The economy grew by 5.3% in 21.
They're
with
tapering
GDP
it on.
returning
It's already
to its
announced they'll be
pre-pandemic
done in a
level
few months.
at the end of 21. However, growth slowed to 0.3% in the final quarter of 21 and is expected to remain weak during the first quarter of 22. The prospects for the
All over
economy
the place.
will depend on the course of the Russia-Ukraine war and on the impact of economic and financial sanctions and other measures. At the same time, other headwinds to growth are now waning. In the baseline
Okay, this
of
is
the
the
staff
1 hour
projections,
21.
the euro area economy should still grow robustly in 22, but the pace will be slower than was expected before the outbreak of the war. Measures to contain the spread of the Omicron coronavirus variant have had a milder impact than during previous waves and are now being lifted. The supply disruptions caused by the pandemic also show some signs of easing. The impact of the massive energy price shock on people and businesses may be partly cushioned by drawing on savings accumulated during the pandemic and by compensatory fiscal measures. Over the medium term, according to the baseline of the staff projections, growth will be driven by robust domestic demand, supported by a stronger labour market. With more people in jobs,
Okay,
households
remember, that's
should
the 1
earn
hour
higher
21.
incomes and spend more. The global recovery and the ongoing fiscal and monetary policy support are also contributing to this growth outlook. Fiscal and monetary support
Doesn't matter, Tom. It's a
remains
central bank. You
critical,
can spend as much as
especially
you want. It's
in this
fiscal that
difficult
you got problems
geopolitical
with.
situation.
Central banks don't have to. Well,
Inflation
They can, but
increased to
anyways, we'll leave it at that. It's
5.8% in
different.
February from 5.1% in January. We expect it to rise further in the near term. Energy prices, which surged by 31.7% in February, continue to be the main reason for this high rate of inflation and are also pushing up prices across many other sectors. Food prices have also increased owing to seasonal factors, elevated transportation costs, and the higher price
Right there.
of fertilizers. Energy costs have risen further in recent weeks, and there will be further pressure on some food and commodity prices owing to the war in Ukraine. Price rises have become more widespread. Most measures of underlying inflation have risen over recent months to levels above 2%. However, it is uncertain how persistent the rise in these indicators will be, given the role of temporary pandemic-related factors and the indirect effects of higher energy prices. Market-based indicators suggest that energy prices will stay high for longer than previously expected, but will moderate over the course of the projection horizon.
let me know what currency
Price
pairs you want to
pressures
look at, or
stemming from
commodities, or
global
whatever.
supply
Let me know what you want to
bottlenecks
cover. Well,
should also subside.
maybe during or after she's done.
Labour market conditions have continued to improve, with unemployment falling to 6.8% in January. Even though labour shortages are affecting more and more sectors, wage growth remains muted overall. Over time, the return of the economy to full capacity should support somewhat faster growth in wages. Various measures of longer-term inflation expectations derived from financial markets and from surveys stand at around 2%. These factors will also contribute further to underlying inflation and will help headline inflation to settle durably at our 2% target. The risks to the economic outlook have increased substantially with the Russian invasion of Ukraine and are tilted to the downside. While risks relating to the pandemic have declined, the war in Ukraine may have a stronger effect on economic sentiment and could worsen supply-side constraints again. Persistently high energy costs, together with a loss of confidence, could drag down demand more than expected and constrain consumption and investment. The same factors are risks to the outlook for inflation, which are on the upside in the near term. The war in Ukraine is a substantial upside risk.
Yeah, but it still has to
especially
pass
to
the
energy
Senate.
prices. If price pressures feed through into higher than anticipated wage rises, or if there are adverse, persistent supply-side implications, inflation could also turn out to be higher over the medium term. However, if demand were to weaken over the medium term, this could also lower pressures on prices. The Russian invasion of Ukraine has caused substantial volatility in financial markets. Following the outbreak of the war, risk-free market interest rates have partially reversed. The increase observed since our February meeting and equity prices have fallen. The financial sanctions against Russia, including the exclusion of some Russian banks from SWIFT, have so far not caused severe strains in money markets or liquidity shortages in the euro area banking system. Bank balance sheets remain
that's just over $200 on one mini,
owing to robust capital positions
to figure out is
and
that a big
fewer
move or
non-performing loans.
So in about
banks
30
are now
minutes,
as profitable as they were before the pandemic. Bank lending rates for firms have increased somewhat, while lending rates for household mortgages remain steady at historically low levels. Lending flows to firms have declined after increasing strongly in the last quarter of 21. Lending to households is holding up, especially for house purchases. So summing up, the Russian invasion of Ukraine will negatively affect the euro area economy and has significantly increased uncertainty.
Here's your Aussie CAD.
If the baseline of the staff projections materializes,
over the medium
economy
term,
should continue to rebound.
I'm a bear on this, on the medium
thanks
term,
to the declining impact of the
months.
pandemic and the prospect of solid domestic demand.
But
and
right now we're still riding
markets.
the 21, so we're kind of trapped here.
Fiscal measures, including at the European Union level, would also help to shield the economy. Based on our updated assessment of the inflation outlook and taking into account the uncertain environment, we revised our schedule for net asset purchases over the coming months and confirmed all our other policy measures. We are very attentive to the prevailing uncertainties.
So you want to see it enter the apex?
The calibration of our policies will remain data dependent and reflect our evolving assessment of the outlook. We stand ready to adjust all of our instruments to ensure that inflation stabilizes at our 2% target over the medium term. And we're now ready to take your questions.
A little bit of volatility today.
Thank you, President Lagarde. And today the first question goes to Caroline Look of Bloomberg News. Caroline, please.
Hi, good afternoon, President Lagarde, and thanks for taking my question. My first one is, a lot of the recent communication from the ECB has been about how supply-driven the current inflation and even core inflation surge is. So how much agreement was there in the Governing Council about accelerating the pace of normalization now? And secondly, your new guidance states that interest rates will follow some time after net bond buying ends. So does that mean that we are back to excluding rate hikes later this year, or how does that square with the significantly higher inflation projections you just presented?
Does she know the webcam is
Thank you very much for your 3
5 feet
questions.
above her head?
First of all, in terms of Governing Council, we had very intense discussions about the current economic situation, about the outlook, about the uncertainty. And as with most institutions, communities, families, and probably you all, the war of Russia against Ukraine has tainted and overshadowed a lot of those discussions. There were different views around the table in all directions. But after those good discussions, there was a determination by all Governing Council members to rally the proposal that was put together by the Executive Board and presented by our Chief Economist. It takes a balanced approach. It delivers on the mandate that we have, which, as you know, is price stability in the face of what we are seeing. So your second question related to accelerating normalization. That was not the decision that was made today. The decision that was made was to progress step by step, to acknowledge the added uncertainty that we are facing, and to therefore have added optionalities so that we can, in all circumstances, respond in an agile way. You will have noted that our decision in relation to asset purchases under the APP is conditional and clearly states that we have a declining pace of purchase for Q2, and that for Q3, if the outlook for medium-term inflation is confirmed by the data, we will indeed end asset purchases. But if, on the other hand, the data, which are critically important because we are data dependent in our decisions, do not support this medium-term outlook as we see it now, then we indicate very clearly in the monetary policy statement that I have just read that the Governing Council stands ready to revise, both in terms of timeline and in terms of volume, its purchases. So it is a conditional provision that you see in our decision. And we are not in any way accelerating. This was in line with our December meeting, with our February meeting and press conference. And what we are doing is confirming our step-by-step approach, our maximum optionalities in the face of maximum uncertainty, but also delivering on our mandate, which is price stability. The medium-term inflation outlook, both in the baseline delivered by staff and in the scenarios that you will see tomorrow in details, which are all, of course, a worsening of the situation. There is not a positive and a negative. They're both more negative. But in all those baseline and 2 scenarios, the medium-term inflation outlook arrives roughly at target. I think in terms of optionalities, I'll be happy to expand a little bit because this is clearly what has guided us. Added uncertainty, added optionalities. So what are we doing? We are clearly identifying the pace. We are procuring a situation where we can decide, sometime after net asset purchases, what decision we should make in relation to rates. In terms of timeline, we're also saying that we will end net asset purchases.
Let me know if you want me to
under
cover
those
something.
data that I have
I'm
just
okay with
described
that.
in the course of Q3. Q3 is 3 months. So we tried to have as much optionality in order to deal with the situation. I have underlined in my response to you,
Look how tight it is, and then
sometime
pop,
after,
pop, pop.
which is a substitute to shortly before. And obviously, sometime after is an open time horizon,
Nothing's
which will
on
be
my
data
mind.
dependent. The occurrence of which will
Remember,
be data
we already
dependent.
knew CPI
that
was
was
high.
your
We
third
already
question.
knew the ECB wasn't
Sometime,
going to
I think
do
I have
anything.
explained it with this response. I hope so.
Thank you, President Lagarde. And the next question is for Annette Weisbach of CNBC. Annette, please.
Thank you very much for taking my question, President Lagarde. I would like to ask you a question because on the surprise factor you actually introduced today, because most of your watchers were completely convinced that you're going to pause and not change anything because of that heightened uncertainty. So perhaps you could elaborate a little bit on the thinking in the Governing Council on that issue to now reduce the pace of the APP, and why didn't you wait another month?
Stuck in the middle.
And then I'd like to go back.
I just
as
did
well
it,
to the
JR.
rate
I was
question.
just like,
of course, sometime
what was it,
after
33 seconds ago?
could mean anything, but I would like to bring you back to that question whether you see a rate hike if things develop according to your dominant scenario now in the course of this year. Thank you very much.
You know, thank you for your question, but I will have difficulty addressing your second questions because I don't know what is my dominant scenario. We have a baseline and we have two scenarios. One is adverse, one is severe, and you will have all the details of those scenarios tomorrow. Suffice to say that, you know, watchers are not those who make Governing Council decisions. It is the Governing Council, 25 sensible people around the table who look at what their mandate is, what the projections deliver, what the medium-term outlook for inflation looks like, what the risks are, what the uncertainty is, and on the basis of all that, who are trying to deliver a predictable course while being very cautious. So that's really what we did. And, you know, doing what you have to do should be the predictable thing. Adding uncertainty to an uncertain situation
Articulated dream saying,
not
how?
have been the
How
right
do you feel
answer.
about the upcoming Fed meeting? We already know what it is, what they're doing.
Now, you
They've
coming
already
back
told
to
us
this,
under congressional
sometime
testimony, 25 basis points,
We
probably
came
every
from
meeting, probably only to 1.5%.
shortly before, because it addressed actually one end of the spectrum relative
think
to
they
the
might-
others. In other words,
They're likely
the
to
time it
delay
takes
balance sheet
to
reduction. I think
purchase
that's what we're
assets
going to learn on March, that they're going to delay
relative
that.
to the time when interest rates could be hiked.
That's it.
And
But
it did
all
say
that stuff we
shortly before,
basically,
so there was an assumption
well, more
that
than basically,
there
we
would
already
not
know.
be such a long period of time between net asset purchases would stop and there would be a rate hike. And it was decided, and we debated that indeed, to replace it with sometime after. And that respects
James, it takes
the sequencing
25
that we
because
had,
if you had
which is
24,
net
you
asset
could get a
purchases.
tie.
And subsequently, the Governing Council looks at all the data to determine whether it is time to hike rate or not. And clearly, sometime after is all-encompassing. It can be the week after, but it can be months later. And by that, I think we want to indicate that the time horizon is not what is going to matter most. It's the data that will support the decision that is made by the Governing Council to assess medium-term inflation outlook and whether a rate hike is warranted. You will have noted, by the way, that we have removed the bias that we had by eliminating lower in relation to interest rates. Thank you.
Thank you, Madame Lagarde. The next question is for Francesco Canepa of Reuters.
Once again, Tom,
Francesco, please.
you're discussing demand side equations when it's a supply side issue. Paul Volcker could not come in and force
Francesco,
more
can you hear us?
semiconductors to come into the market.
We cannot hear
Paul
you.
Volcker can't force BMW
We
to
will
make
then
more
go
cars.
to someone else and I'll come back to you. So in the meantime, Isabella Bufacchi of Il Sole 24 Ore, please. Isabella.
Good afternoon, and thank you for taking my questions. I apologize for the video that is not on. President Lagarde, I have a first question on your financial stability toolbox. How far is the Governing Council worried about financial stability in the euro area? You made a reference to the no liquidity shortages, but you did announce the liquidity lines. So maybe you can tell us what you can do if for the financial stability. And then a second question is actually on digital currencies. I know you made so many decisions today, but EU sanctions targeted the Central Bank of Russia in an unprecedented way, and this triggered a new focus on central bank digital currencies. Can we expect that the ECB is going to accelerate the process for the digital euro? Thank you.
Do you also expect?
Thank you, President. I will try to answer your question on financial stability. Well, it's quite clear that we have seen since the beginning of the invasion, volatility, tensions, stress in financial markets. But I think that perhaps, the main point that I would like to stress is that this situation is not comparable to the one that we had 2 years ago. Liquidity has not disappeared from the markets. And despite, the situation of tensions that we have seen in certain financial and capital markets, liquidity, as I have said before, has not disappeared. We are closely monitoring the different financial markets. We have seen a lot of volatility, for instance, in equity markets. As well, we are also looking at what's happening with corporate bonds. In terms of corporate bonds, spreads have widened, but as I said before, liquidity has not faded out. And finally, there is a very specific market that we are looking very carefully. That is the derivative market. And mainly, one part of this derivative market is the commodity derivative market. So far, in the clearing houses, we have not seen any sort of a special volatility there. All the margin calls derive from the increase in commodity prices.
Careful with Aussie yen, huh?
But we are closely monitoring the situation. And finally, in the government bond market as well, we have seen ups and downs in terms of nominal yields, but the spreads have been quite contained. So the conclusion is Russia is important in terms of energy markets, in terms of commodity prices, but in terms of the exposure of the financial sector, of the European financial sector to Russia, is not very relevant. And simultaneously, the size of the Russian economy is quite limited. It's only 2%, roughly, of the world economy. So the situation, perhaps, the main conclusion is that the strains and the tensions that we have seen are not comparable at all to what it happened at the beginning of the pandemic.
Yeah. And on your question concerning CBDC, you know my views on CBDCs, and you know that I have pushed that project. Fabio Panetta is working hard on that together with members in the entire Eurosystem, with a high-level task force that is working really hard on moving forward. But in a way, I'm really pleased that attention is now focused on the role that cryptos can play and the role that central bank digital currency can have when they are implemented.
So the thing on Euro Swiss you have to watch is parity.
We decided, the Governing Council decided back in October 21 to launch a two-year investigation phase. And it is at the end of that investigation phase that the decision will
I believe it's the major reason Euro flipped.
To launch the CBDC and to make it a reality. We can't go wrong with that project.
Nothing can
I'm
go wrong.
I'm confident
go.
that we will move ahead, but that's going to be a decision of the Governing Council.
We're in the Congo.
I think it's an imperative to respond to what the Europeans expect, and I think we have to be a little bit ahead of the curve if we can on that front. So if we can accelerate the work, I hope we can accelerate the work. I will certainly support that. And I was delighted to see that in the United States, there was an executive order by President Biden to actually expect similar effort and focus and progress on CBDCs, cryptos. And I think that it will take all the goodwill of those who want to support sovereignty, who want to make sure that monetary policy can be transmitted properly using our currency will endeavor. On the issue of financial stability, I totally concur with
Bitcoin
my Vice President, de Guindos, but I will also point you to the last sentence in the first paragraph of our monetary policy statement. And I know that there's been an abuse of that, but we mean it. We will take whatever action is needed to fulfill the ECB's mandate to pursue price stability and to safeguard financial stability. So, have no doubt.
Thank you, President, Vice President. Francesco, we want to give it another try, so please ask your question. Some transmission problem today. So then I would give the next question to Klaus-Rainer Jakisch of ARD Television. Klaus-Rainer, please, for you.
Right on my line, huh? Gee whiz.
Klaus-Rainer, we cannot hear. I see you talking, but we cannot hear you.
Monthly resistance.
Until the problem is sorted out, I will then give the question to Martin Arnold of Financial Times. Martin, I hope we can hear you.
Hello, President Lagarde. Can you hear me?
Yes, indeed.
Yes, we can hear you.
Excellent.
Jeez.
My two questions are as follows. Firstly, with the ECB now accelerating...
He's wearing a pink shirt because of their newspapers pink? That's
monetary policy stimulus. Do you think the onus must be on fiscal policy to support the Eurozone economy from the impact of the shock from the Russian invasion of Ukraine? And the second question is, what would the ECB's reaction be if the Ukraine Central Bank was to request a swap line from the ECB? Thank you very much.
Well, thank you for your question. I'll start with the second one.
We're coming up to the hourly 21 as support.
Together with other European authorities, and in particular with the Commission, how we can deploy tools in order to support the Ukrainian people
He's suggesting
and
US
the
dollar
Ukrainian
will weaken.
authorities. So clearly looking at how support can be structured, whether under existing product, you mentioned swap line, repo line, or under other products, because clearly we have conditions under which we can extend swap lines and repo lines. And if those conditions are not satisfied, we need to find alternative ways of providing support. And that is what we're doing, both in relation to the authorities, but also in relation to the people of Ukraine, who, when they become refugees, unfortunately, pass the border, need to access alternative currencies to theirs, which, as a result of the decision that was made, is not convertible as it used to be. So we are really working hard. I hope that in the next few days we'll be able to provide tools and means to extend support to both the people and to the authorities, together with the Commission and sometimes, in some cases, national authorities within the Eurosystem. On your other point, let me just make that clear once again. The decisions that we are making today are the
stock market's not even open
logical continuation of our December decisions, of our February communication, and we are on this path which is data determined and which is also delivering on our mandate, which is that of price stability. So we're not talking about accelerating, we're not talking about tightening, we're talking about normalizing, simply because we acknowledge the fact that in the present environment, which is that of high inflation and not low inflation, as it was in the past, the support that net asset purchases can give to policy rates is getting close to conclusion, and therefore requires that we decelerate the pace of purchases, consider the fact in Q3, or at the end of Q2 rather, to decide whether, depending on the data that we get, we effectively conclude net asset purchases, the principle of which was agreed today. Thank you.
Thank you, Madame Lagarde. I see that now Balazs Korani from Reuters is connected, so perhaps you can connect Balazs for you, please.
I'm trying my best. Do you hear me?
Yes.
Great. Apologies for this technical issue. President Lagarde, in your
is that the tech support guy right
you mentioned
behind
that
him?
in the discussion there were various options being discussed, or at least advocated
Eric
by
B
government
and
council members.
LL, well, hell.
Would you tell us a bit
Rockets
more?
for
Was there
anthrax. Still we can
were there
rock
people
bells.
who suggested no end date, or what were the
What's up,
options
Eric B?
that governing council members advocated? The other question I have is sort of this longer, broader question about inflation. I think it's clear that even after the war, there's no returning to the pre-war normal. Governments are spending more on defense. Commodity prices are likely to stay higher than before, and the green transition is going to be accelerated. Now, all of these factors are long-term inflationary, I believe. Is this something that you discussed in the Governing Council, and how were these factors taken into account in your projections?
On your first question, I'm sure that some of you will really enjoy picking up the phone and trying to question who said what, when, and on one topic. Let me just be very clear on that. There were some members who thought that given the uncertainty that we have, we should be uncertain as well and do nothing. There were other members who thought that
so we're right in the open range here.
We should move ahead and not have any conditionalities. Okay, so you have both ends of the spectrum.
Maybe mark this for today or tomorrow.
And I think that the proposal that was debated and supported by the executive board and presented by Philip Lane, the chief economist, was this balanced approach of taking into account the baseline produced by staff, acknowledging the inflation numbers that we are seeing now and the inflation outlook that we have for the medium term, to propose a path that reduces net asset purchases, brings us to concluding the net asset purchases under the conditions that data actually confirm the outlook that we are seeing now and that we are seeing in the scenarios produced by staff. So that's what the package was, and it is a package. It's a package of a determination, conditionalities, the removal of the shortly before, which has not been replaced by shortly after, but by sometimes after, so as to delink, and maximum agility and flexibility, as you will have seen in the description of the various instruments, and I think that was published in the press release. And I'm here referring clearly to flexibility that we give ourselves under the PEP reinvestment policy. Speaking of reinvestment, let's not forget that we have a I just want to, maybe I'll have the right exact number that I can give you in terms of reinvestment policy under the APP. I thought I had that somewhere.
Have you been to the APP store yet?
Anyhow, we have more than 5 trillion euros worth of assets that we will be reinvesting over the course of time. So it's not as if we were, tightening monetary policy going forward. We are normalizing monetary policy with the caveats that I have just outlined. Now, obviously, when we look at the medium-term inflation outlook, we also do a risk analysis. And while we are clearly of the view that given the drivers behind inflation, energy predominantly for the moment, supply bottlenecks, food prices increases, and a broader increase of prices in general, which is coming from energy predominantly and translates throughout all the items. Clearly, risks to inflation is to the upside, particularly in the short term, but possibly also in the medium term, but not exclusively, because risk to inflation could also be to the downside. So you mentioned some of the investment projects, some of the fiscal spending that will probably take place over the course of the next few years. And that will certainly continue to push prices up. If anything, it's a good reason that we should stick to our mandate of price stability and of bringing medium-term inflation outlook to our target of 2%. Thank you.
Thank you, Madame Lagarde. And the next question goes to Mark Schreers of Börsenzeitung. Mark, please.
Look at that inside
you are muted, Mark,
week.
still.
S1R1.
Can't hear you. No.
They don't have Zoom in Europe? I don't know how to use a mic.
No, sorry. I will then go to Eric Albert of Le Monde.
Why don't they test their
Eric,
audio and speakers before going into the meeting?
Good afternoon. I hope you can hear me.
Probably don't know how to use their cell phone either.
Thank you very much for taking my question. I got a couple of questions. One on the fiscal side. As we are talking now, the EU leaders meet in Versailles. How much can you expand a bit on what you expect from the fiscal side, especially from the EU side? Would you like to see some common borrowing again? And on the inflation, mostly on the energy shock, before the war, there was already a pretty big energy shock, but some hope that maybe it was stabilizing. There's absolutely no hope now that it will stabilize in the short term. How long-lasting do you believe this energy shock might be? It looks like if Europe turns its back to Russian gas and oil, there will be a very long-lasting shock, and it will be for the foreseeable future. What do you say to that?
Well, thank you for your two questions. On the first one, which relates to the fiscal effort, we clearly point out in the monetary policy statement that fiscal support will continue to be critically important. What form it takes, whether it is a national fiscal effort with a good focus, with target on those that are most affected by the current crisis, particularly energy crisis, or whether it takes a European-wide format, is something that obviously the leaders will have to decide, and I'm sure that they are, as we speak or as they meet, be addressing those questions. I think we have a long-standing record of arguing for some fiscal facility at the European-wide level in order to respond to shocks. We are clearly facing a major shock, whether it is just the pure war or whether it is the energy prices. But this fiscal facility that we've advocated we stand by and do believe that it can be extremely helpful, particularly in order to move Europe to a more integrated basis. On the, when will energy prices stabilize? In our assumption and in the scenarios that have been developed, there is the assumption that oil and gas and energy prices in general will, throughout the projection exercise,
coming back
stabilize.
To the bottom.
Certainly not in the short term.
Coming back to the bottom, yo.
What we are not seeing, and that takes me a little bit away from energy prices, but it's clearly related to how long it takes to stabilize. But what we're not seeing so far, and we are very, very much scrutinizing the numbers, is wage pressure. When we look at the numbers for the fourth quarter of 21, the wage increases have actually been lower than the average of 2020. So we are trying to get as much intelligence and as much understanding of how and where wage pressures are going to come from, because it will have an impact on the underlying inflation that is integrated in our medium-term outlook and in our forward guidance. Thank you.
Thank you, President Lagarde. And the next question is for Eshi Nelson of the New York Times. Eshi, please.
Hi, can you hear me okay?
Yes.
Okay, fantastic. Thanks, President Lagarde. Just two quick questions. To what extent was the plan the EU put forward to reduce its dependency on Russian energy considered in the current forecast for inflation? And secondly, on your point about a short time after that wording for raising interest rates, are we supposed to read that as
it's not a
longer wait than how it was described before, where asset purchase program would end shortly before interest rates would increase?
I would have to double check on your first question, because I'm not aware that the plan to reduce dependency on Russian gas was incorporated as a geopolitical decision or as an energy decision made by the European authorities and with the national leaders of the member states. What I know for sure is that we factored in a significant increase of prices wherever that product comes from. On the, sometime after, I know this seems like
just be careful with
great
WTI,
and in a way it was. We could have
WTI
substituted the shortly
versus
before
Euro
by
USD
shortly after, but that would have made it too time dependent in terms of decision making. We want to be data dependent. So whenever the data
as far as price
confirms that the medium-term inflation outlook is at target, then
it would take you a whole day to lose $100.
We are guided by our strategy review. We are guided by our forward guidance. We're not guided by
you could lose
the time
$100
element
on this in
that would predicate that within X weeks or within X months, decision will be made. So the use of the deliberate use of some time after opens sufficiently wide an interval of time so that we can review the data, determine the robustness of the data, make sure that some uncertainty has cleared a bit so that we can make a decision. I don't know how I can more explain this sometime after, but that's what our debate was about.
Yep.
Thank you, President.
And again, if I can just insist on that, we want to have as much optionalities as possible. We recognize that there is huge uncertainty and that things can go in all sorts of directions. And we want to be able to respond to those circumstances. And to do that, we need to have all optionalities on the table. We keep all the options opened, and we will proceed, and we are proceeding step by step.
The next question is for Azahara Sanchez of the Spanish television La Sexta. Azahara, please.
Hi, thank you. Can you hear me?
Yes.
Okay, thank you very much. My question is for Vice President Beginners. Back in 2012, when you were Spain's economy minister and the Sareb was created, you were in a press conference with
She's got a headphone on, but she's using her laptop microphone instead of the microphone on the headset.
€1 for the taxpayer, and you yourself said that it would minimize the impact that the bank intervention could have in the cost for the taxpayers. Now Sareb's €35 billion in debt is officially public debt. Did you fool Spanish people back then? Thank you.
Well, what I have to say is that Sareb was part of the package
the professionalism is
to
just
rescue the Spanish
really
financial system.
low, huh?
And it was agreed with the European Commission, with the ECB, with the IMF. And Sareb was perhaps the most powerful instrument in order to clean up the balance sheets of the Spanish banks. And I think that it's right. It has a debt of 35 billion euros.
Kiwi kicking butt,
but as
Aussie
well
kicking
now,
butt,
it
euro
has
coming down.
assets worth clearly beyond 32 billion euros. So Sareb has been quite a useful instrument that was used as well, and this instrument was used in other countries like Ireland, for instance. And I think that what we have to do is to try to gain time in order to get advantage of the evolution of the real estate in Spain, that now is much more positive, and to reduce as much as possible the level of debt of Sareb.
Yeah.
Thank you, Vice President.
Lucas,
this brings
I love
to the
it.
end
I love
our
the
press
Canadian
conference
dollar.
today. Thank you very much for joining. Our next regular press conference is on 14 April, and up until then, best wishes, stay safe. Thank you. Bye-bye.
All right, well, I guess that's it, right? So ECB did nothing. That makes sense. And it went up, hit resistance, and now is coming down. Okay. We're at the cycle level of 150 on this thing. Could be interesting. And this is a pretty big move, huh? Like it's up and then down, and that's well over 100 pips. Yeah. So be careful out there, huh? So I'll leave you to it. We all got something to do. So peace on earth. May the pips be with you. May your profits be above average. Play it safe out there. You can try to grab